Now, for more on how cashless movement is taking off in Africa, I spoke with Nathan Byrd. Nathan is the head of global programs at Opportunity International. I began by asking about how this shift is shaping economies there.
Well, it's tremendously important, and it responds to incentives in the market. One of the interesting figures out there is that the rate of mobile money adaptation amongst developing markets is much faster than developed markets, and this is because there's a need. In developing markets, you have much looser restrictions on financial institutions. You have much less pervasive financial systems, and so what happens is if you're on one side of India and you need to get money to the other side of India, there's much greater need for fintech to come in to assist you with that transaction, whereas if you're in the United States and you're working with a brick-and-mortar national financial institution, it's a lot easier to move that money. And not only are customers inclined to move on to mobile money, as these developing market financial institutions become more heavily regulated under treaties like Basel III, for example, we're seeing that those restrictions are putting constraints on financial institutions in which they need to find a way to drop their own cost base. And as they work to drop their own cost base, one of the best ways to do that is to go digital. And so we're seeing a push from a number of sides that are driving mobile money adaptation across markets.
And what are some of the sectors you're primarily seeing cashless use in?
Sure. We're seeing it definitely in the agricultural space, where rural farmers, for example, are much harder to reach. And we're finding it's also popping up in just general microfinance business and some more basic commercial, more urban and peri-urban transactions. And the reality there is that we're seeing mobile money solutions pop up first and foremost to service those urban and peri-urban clients that have the most demand for it and have the highest flow of cash running through their wallet on a day-to-day basis. But we're seeing systems like M-Pesa in Kenya, for example, tackle the market very quickly. You now see 40% plus of the GDP of Kenya, the entire GDP of Kenya, running through M-Pesa's transaction systems on an annual basis. At the same time, you see almost half the country's population serviced by it. The problem is that solutions for spaces like education are much slower to adapt. And what we're finding is we've gotten pretty much every client onto the system who's easy to get to. So now we're coming into questions of financial inclusion. Sectors like school, education are extremely important to get into mobile money solutions. Right now, if you go to a brick and mortar financial institution and you do a paper-based transaction, and where the paper itself has to go through a branch and then up to a head office credit committee and then come back through that process and get back to the client, you could be talking 14 days to get a loan just for school fees, for a couple $100s for school fees maximum. But during that period of time, if you were last minute about your solution, which many of us often are, you could watch your kid not go to school for the first two months of the year.
Now, I do want to look at a recent MasterCard study which says that 85% of the world still uses cash. So essentially, we're seeing that cash is king, but it's harder to trace these cash transactions, and that's a reason we're seeing a lot of governments trying to scale back on cash transactions and large denomination bills, especially because of its links to criminal activity. But in terms of its legal uses, what are the current benefits of still using cash?
Yeah, I mean, cash is what you use when you're in a bind, when you're in an emergency situation. And frankly, in urban markets, that's less of an issue. You can go to an ATM and get cash relatively quickly, or you have many of your providers, many of your shops and hospitals will use either mobile money or credit card services or debit card services. But when you go to more rural environments where fewer people are included in the digital revolution, cash is still king. At the same time, as much as there is this element of digital financial services replacing cash for urban, middle income, and wealthy individuals, you still have this issue of, you still have a number of people in those environments wanting to use cash to avoid traceability so that their data isn't being utilized to be targeted for retail solutions and other things. Think about Amazon and how they're using your data. Think about Google and how they're using your data. There's an element of, even though you don't have as much traceability, you really miss out. If you're a poor farmer, for example, as we talked about in rural Kenya, one of the major challenges that you're going to have in accessing a loan is that you've never been exposed to the credit bureaus, because any loan you've taken is through a small-time money lender or through a microfinance institution who isn't reporting into the credit bureau.
Right.
So this is why coming onto digital platforms where there is traceability is actually really important for people to be able to continue to access finance on a regular basis or be included in the first place.